The financial markets just witnessed a historic bloodbath that will be forever remembered as the Valentine's Day massacre. Billions of dollars in precious metals wealth vanished instantly, leaving millions of investors in absolute shock today. The crash happened so fast that human traders could not react before their accounts were completely wiped. On Thursday, February 12th, gold and silver experienced a volatility event that defied all statistical models known. In just 30 minutes of trading, the price of silver plunged by 11% without any warning. Gold followed the crash, dropping $163 in the same short, violent window of time. This was not a natural market correction. It was a forced liquidation triggered by algorithmic trading bots. We are witnessing the dark side of high-frequency trading, where machines destroy wealth in milliseconds for profit. The total damage is estimated at over $2 billion in leveraged positions liquidated in mere seconds. If you held silver futures on margin, your entire account balance likely went to zero this morning. Before we analyze the specific mechanics of this crash, make sure you are subscribed to Finance Truths. To understand this disaster, we must look at the market conditions leading up to this fatal moment. Gold and silver had been rallying for weeks, drawing in retail investors looking for a safe haven. Sentiment was at an all-time high, with calls for silver to break $50 flooding the internet. This optimism created a dangerous leverage bubble as traders borrowed money to bet on higher prices ahead. The smart money saw this overcrowding and decided to pull the rug out from under the herd. It began with a massive sell order that hit the futures market at exactly 9:30 morning. The size of the order was large enough to clear out all the buy orders in the book. This initial push triggered a cascade of stop-loss orders from retail traders protecting their long positions down. As prices fell, the algorithms sensed the weakness and began to short the market with aggressive speed. The selling pressure overwhelmed the liquidity providers, causing the bid price to disappear completely from the screens. For several minutes, there were simply no buyers for silver, sending the price into freefall towards zero. This is known as a flash crash, a structural failure of the modern electronic financial market system. The drop of 11% in silver is a statistical anomaly that should only happen once a century. Yet, we are seeing these events happen with increasing frequency as AI dominates the daily trading volume. The $2 billion liquidation figure represents real money lost by real people in a single hour. It is a transfer of wealth from the hands of the many to the hands of few. The major banks and hedge funds were on the other side of this trade, buying the panic. They waited for the forced selling to exhaust itself before stepping in to buy at bargain prices. This predatory behavior is perfectly legal in the unregulated Wild West of the futures and commodities markets. Regulators are currently investigating the crash, but history tells us that nothing will change in the system. The Valentine's Day crash serves as a brutal reminder that leverage is a double-edged sword for investors. When you trade with borrowed money, you do not need a crash to lose everything you own. A simple volatility spike is enough to trigger a margin call and close your position for loss. The exchange computers do not care about your feelings. They only care about solvency and risk management. When your account equity falls below the maintenance requirement, the system liquidates your holdings without asking you. This is exactly what happened to thousands of traders on Thursday morning during the chaotic market session. They received notifications that their positions were closed at the absolute bottom of the crash, locking losses. The psychological impact of such a sudden loss can be devastating for those who were not prepared. Many had placed their life savings into these trades, believing that gold was a guaranteed safe bet. But in the short term, the price of gold is determined by paper contracts, not physical metal. The paper market is a casino where the house sets the rules and always wins the game. We saw gold drop $163, a move that defies the fundamentals of supply. Physical demand for gold remains robust, with central banks and nations buying record amounts every single month. However, the spot price is driven by the futures market, which is detached from physical reality today. The disconnect between paper price and physical price has never been wider than it is right now. While screens showed gold crashing, bullion dealers were reporting steady premiums and tight supply of real metal. You could not buy a gold coin for the low price shown on the trading screen Thursday. This proves that the crash was a manufactured event designed to shake out the weak hands quickly. The AI-driven margin calls mentioned in the news are the key to understanding this modern financial weapon. These algorithms are programmed to hunt for liquidity pools where stop-loss orders are clustered together on charts. They push the price just enough to trigger the first stop, creating a domino effect of selling. Once the momentum starts, the AI accelerates the move, profiting from the panic it helped to create. It is a self-fulfilling prophecy of destruction that leaves human traders helpless to stop the bleeding out. The speed of the crash was so fast that arbitrage bots could not keep prices in line. Silver on the COMEX exchange was trading significantly lower than silver on the London market for minutes. This dislocation shows that the market structure completely broke down under the immense pressure of the selling. Traders who tried to log into their accounts found their platforms frozen or lagging behind reality. They watched helplessly as their account values plummeted, unable to execute any orders to save their capital. This technological failure adds insult to injury for the retail investors who were the primary victims here. The exchanges will claim that their systems functioned as designed, executing orders to maintain overall market stability. But for the individual trader, the system failed to provide a fair and orderly marketplace for trading. We must ask who benefits from a crash like this, and the answer is always the same. The entities with the deepest pockets and the fastest computers act as the predators in this ecosystem. They use these volatility events to accumulate massive positions at discounted prices from forced sellers in panic. The $2 billion that vanished did not disappear. It just moved from your account to theirs. It is a zero-sum game where the sophisticated players feast on the inexperienced participants in the market. This event has shattered the confidence of many gold bugs who thought the bull market was unstoppable. It introduces fear and doubt into a market that was previously driven by greed and high expectations. This emotional shift is exactly what the smart money wants to see before the next leg up. They want you to be afraid to buy the dip so they can have it all themselves. The narrative of a forced liquidation conveniently blames the victims for taking on too much leverage risk. But it ignores the manipulative nature of the price action that triggered the liquidation in first place. If the price had not been pushed down artificially, those margin calls would never have been triggered. It is a classic stop-run strategy executed on a massive industrial scale by billions of dollars. The timing of the crash, right before the weekend, adds another layer of suspicion to the event. It forces traders to steward their losses over the weekend, increasing the psychological pain and the fear. We are entering a new era of market warfare where AI is the primary weapon of choice. The Valentine's Day crash is likely just a preview of the volatility we will see in future. As more capital flows into passive and algorithmic strategies, the potential for flash crashes grows exponentially larger. The human element is being removed from price discovery, replaced by cold, hard mathematical logic and speed. This makes the markets more efficient in theory, but much more fragile and dangerous in practice today. Risk management is no longer just about analyzing the asset. It is about surviving the machine attacks. You must understand that you are not trading against other people. You are trading against supercomputers now. These machines do not sleep, do not feel fear, and process information faster than you can think. The silver market is particularly vulnerable to these attacks due to its relatively small size and liquidity. A few $billion can move the silver market significantly, unlike the massive treasury or currency markets. This makes silver the perfect playground for high-frequency traders looking to engineer a volatility spike for profit. The drop of 11% in 30 minutes is a clear sign that the market is broken. Regulatory bodies are asleep at the wheel, allowing these predatory practices to continue without any real oversight. They will issue a report in a few months, but by then, the money is gone forever. The investors who lost everything today will not get a refund or an apology from the exchange. They are simply collateral damage in the relentless pursuit of profit by the giants of Wall Street. This brings us to the crucial question of how to protect yourself from these inevitable flash crashes. The first rule is to avoid excessive leverage, which is the fuel that powers these liquidation events. If you own the asset outright, a flash crash is just a temporary fluctuation in paper value. But if you are leveraged, a temporary fluctuation becomes a permanent loss of your hard-earned capital wealth. The survivors of the Valentine's Day massacre are those who held physical metal or unleveraged positions firmly. They watched the chaos from the sidelines, knowing that their ounces were safe in their own possession. This event reinforces the mantra that if you don't hold it, you don't really own it today. Counterparty risk is the hidden killer in the financial markets, and leverage magnifies that risk tenfold. As we dissect the aftermath, we must look at the technical damage done to the price charts. The crash has broken key support levels, turning the technical picture from bullish to bearish very quickly. This will attract more short sellers, potentially driving prices even lower in the coming days and weeks. The psychological damage to the bull case is significant and will take time to heal and recover. But for the contrarian investor, this blood in the streets represents a rare and massive buying opportunity. When everyone else is panic selling, the disciplined investor steps in to buy quality assets on sale. However, catching a falling knife is dangerous, and the volatility may not be over for this market. We need to watch for stabilization before committing fresh capital to this chaotic and broken market environment. The Valentine's Day crash will be studied for years as a case study in market structure failure. It exposes the fragility of a system built on debt, leverage, and high-speed algorithmic trading robots. We are living through a period of unprecedented financial instability, where safe havens are no longer safe. The disconnection between the paper price and the physical reality is the most critical signal right now. While the algorithms were dumping paper contracts, the physical market for silver was tightening to extreme levels. Dealers reported a massive surge in buying volume immediately following the crash, draining inventory from the vaults. Smart money investors used the lower spot price to accumulate physical ounces at a significant discount today. This rush to safety has exposed a terrifying new threat that the FBI just warned us about. As demand for physical metal explodes, sophisticated criminal rings are flooding the market with high-quality fake gold. The FBI just raided a massive operation selling tungsten bars wrapped in real gold to unsuspecting investors. These fakes are so advanced that they pass the standard acid tests used by most local dealers. Tungsten has the same density as gold, making it the perfect metal for counterfeiting heavy bullion bars. Victims in New York and New Jersey have already lost over $15 million to this scam. This scandal proves that even the physical market is dangerous if you do not know your source. The timing of this bust is suspicious, coming right as the paper price of gold crashed hard. It suggests a coordinated effort to undermine confidence in both the paper and the physical gold markets. If you cannot trust the futures exchange and you cannot trust the bar, where do you go? This uncertainty creates a liquidity trap, where investors are paralyzed by fear of loss and fraud today. But the real crisis is not in the investment market. It is in the industrial supply chain. Silver is not just a monetary metal. It is a strategic industrial resource essential for modern technology. The flash crash has caused chaos for industrial buyers who rely on stable prices to manage costs. Solar panel manufacturers are the biggest victims, as they consume huge amounts of silver paste for production. 3 major solar companies have reportedly halted production lines because they cannot hedge their silver exposure effectively. The volatility has made it impossible to price their panels for future delivery without taking massive risks. This industrial stoppage threatens to derail the green energy transition that governments are pushing so aggressively now. We are seeing a scenario where the financialization of silver is destroying its utility as an industrial metal. The Year 6 deficit report from the Silver Institute confirms that we are running out of time. For 6 consecutive years, the world has consumed more silver than the mining industry has been producing. We have been eating into the above-ground stockpiles, which are now critically low and near exhaustion levels. The crash on Valentine's Day did nothing to solve this fundamental imbalance between supply and global demand. It only made the problem worse by discouraging miners from investing in new projects to increase output. Why would a mining company spend billions to build a mine if the price can crash instantly? The mining cliff is real, and the major producers like Barrick and Newmont are sounding the alarm loudly. They simply cannot extract more metal from the ground, no matter how high the price goes eventually. Geology does not care about financial derivatives or algorithmic trading strategies executed by high-frequency hedge funds today. The easy gold and silver has already been mined, leaving only low-grade deposits that are expensive to process. This reality sets the floor for prices, regardless of what the paper market manipulation tries to do. The cost of production is rising due to inflation, making the current spot price unsustainable for miners. If prices stay suppressed by these flash crashes, mines will shut down, restricting supply even further tomorrow. This creates a coiled spring effect, where the price will eventually explode upward when physical shortages bite. We are already seeing signs of this stress in the Shanghai market, where premiums are skyrocketing higher. China is draining the physical silver from the West, using the arbitrage window to secure strategic reserves. They know that the paper price is a lie, and they are exchanging paper dollars for metal. The Valentine's Day crash was a gift to the East, allowing them to buy at bargain prices. While American investors were being liquidated, Chinese state banks were reportedly buying every ounce they could find. This transfer of real wealth from West to East is the defining geopolitical trend of this decade. The BRICS nations are building a new financial system backed by commodities, not by debt and promises. The launch of their new unit currency, backed 40% by gold, is a direct challenge to the dollar. This crash may have been an attempt by Western powers to discredit gold as a stable reserve asset. By introducing extreme volatility, they make gold look like a risky speculation rather than a safe store. But this strategy is backfiring as the rest of the world accelerates its move away from the dollar. The $50 billion in oil trades settled in the new BRICS currency is proof of this shift. The US dollar is losing its privilege, and the volatility in precious metals is a symptom of this. Investors must look past the daily noise and focus on the long-term fundamentals of value and scarcity. The paper game is ending, and the rules are changing faster than most people can comprehend today. You must differentiate between the price on the screen and the value of the metal in hand. The screen price is a tool of misdirection, designed to confuse and demoralize the average retail investor. The true value of gold and silver is their lack of counterparty risk in a bankrupt world. When the banking system eventually resets, those with physical assets will be the only ones standing tall. The Valentine's Day crash is a warning shot, signaling that the system is becoming increasingly unstable and fragile. It is a reminder to take possession of your wealth and remove it from the digital casino. Do not let a 30-minute flash crash scare you out of the only real money in history. The volatility is the price you pay for insurance against the collapse of the fiat currency system. Hold the line, stay disciplined, and do not let the algorithms shake you out of your position. The wealth transfer is happening right now, and you need to decide which side you are on. Are you with the panic sellers, or are you with the strategic buyers accumulating real assets today? The choice you make in these moments of chaos will determine your financial future for decades to come. We will continue to monitor the forensic investigation into this flash crash and report the truth to you. The mainstream media will tell you it was a glitch, but we know it was a feature. They want you to believe that everything is under control while the system burns down around them. Do not be distracted by the flashing red numbers on the screen. Look at the physical flows. The metal is leaving the vaults, and it is not coming back to the market at these prices. Scarcity is the ultimate driver of price, and the world is running out of cheap silver now. The next move up will be fueled by desperate industrial buying, not by speculative paper trading volume. When Apple and Tesla cannot get the silver they need, the price will act very differently indeed. Prepare for that day, because it is coming sooner than the market manipulators want you to believe. Protect your family, secure your wealth, and ignore the noise of the dying paper market system today. This is the reality of the financial war we are fighting, and knowledge is your only weapon. Make sure you're subscribed to Finance Truths to stay ahead of the next major market event.